Test, test. Yeah, that works, okay. I should say at the beginning I'm losing my voice. It's tough to imagine something as valueless as a voiceless speaker, so I'm going to do my best. I want to begin by, many of you know I put on my own conference. I've been speaking at other people's conferences for 40 years. It's sort of like herding cats. It's a very difficult thing to do. So I'd like to begin by thanking in particular Kai and his staff for putting on this one conference. I'd like you to join me in a round of applause for Kai and his staff. That was my applause line. I got you all to clap, and I can pretend it's for me. I'm going to tell a joke that I hope well, I'm not going to try to translate it into German. I just hope that the joke will transcend cultures. I pulled it off in Zurich, so perhaps I can pull it off here. And it has to do with the nature of bull markets and bear markets, cyclicality. In the early part of the decade of the 1980s, I visited a town called Midland, Texas, in the heart of the West Texas oil patch. And it's a town that boomed during the oil boom in the 1970s. It just boomed. And when the oil boom busted, Midland busted too. Commercial occupancy fell by 50%. Many businesses went bankrupt. And I visited Midland in 1983 or 1984 in the midst of this ugly downturn, similar to the gold stock market in 2019. And I saw a bumper sticker on a truck. And the bumper sticker said this, and I want you to remember it. God, please give me one more bull market. I promise not to waste this one. I would argue that we are in the midst of a gold bull market. And I would argue, too, that we are approaching a broader natural resources bull market. With regards to the gold bull market, I think the one that we're approaching, and I don't have time to defend the thesis, mercifully, will be as profound as the bull market that some of us enjoyed in the 1970s. A very profound gold bull market. And my hope is that you won't waste it. I've spent a long time now, 50 years I'm embarrassed to say, observing the way investors react to markets for 50 years. And it's interesting that many investors get the timing exactly right, but they get the strategy exactly wrong. In the depths of the bear market, when things are very cheap and you're supposed to be buying, the narrative that would cause somebody to buy hasn't been established by price action, and so investors ignore it. When the price action justifies the narrative, which is to say when you're in a bull market and things are expensive, investors recoup their courage, meaning that many investors in cyclical industries buy high and sell low. Your job simply is to reverse those two circumstances. I'm going to argue that despite the fact that the gold price is up, it is likely, but not certain, to go up not merely more, but much more. That's the good news. The bad news is almost certainly some number of the people in this room will waste that bull market. They'll buy too late, and as the market starts to decline, they'll try to break even. And unfortunately, the backside of these markets is just as steep as the front side. But if you're long, it's a lot less fun. A few lessons that you'll learn about this bull market is that despite the fact that it's a secular market, up, 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 it's also cyclical and volatile, meaning that the up moves that you enjoy will be punctuated by sharp declines. On the floor at this conference in the last 2 days, many people have said to me, Rick, what's your comment on the 8% decline in the gold price that we've seen recently? 50 years of experience have taught me to ask the question, did the gold price decline 8%? Or rather, is over a year and a half the gold price up 100%? It has an awful lot to do with perception. And let me, at the beginning of my talk, issue a small warning to you. If an 8% decline in the gold price and a 25% decline in the price of junior gold shares frightens you, find some other business. This is a business where, in terms of declines, quote, you ain't seen nothing yet. In the gold bull markets, well, in fact, in the commodity bull markets that I've lived through in my life, declines of 25% are commonplace. And a 25% decline in the gold price generally means a 40 or 50% decline in the prices of junior equities. That's all good if you've steeled yourself to it. But what happens too often is the confidence that was manifest as a consequence of increased prices gets obliterated by declining prices. And investors get shaken out in these cyclical declines, and they get shaken out of secular bull markets. It's true, too, that the equity prices often are multiples, both up and down, of the price escalation of the commodity, which is to say, as an example, in the decade of the 1970s, the Philadelphia Gold and Silver Index, the predecessor to the GDX, appreciated at roughly twice the pace of the gold price. Remember, however, that that leverage is magnified on the way down as well as the way up. What I'm telling you is prepare yourself for 25% declines, more than one. And I'll tell you later on in the speech, I hope, how to psychologically prepare yourself for that. And when I talk about declines, I think it's useful to give you a historical perspective. Some of you, I note with pleasure, by the way, that most of the audience is too young to remember this circumstance. But for those of you who were around in the decade of the 70s, you will remember that the gold price rose from a price-controlled $35 an ounce in 1970 to $850 an ounce in 1981, a profound move, 28-1. Some of you will remember that in the middle part of that decade, after the gold price had risen from $35 to $200 an ounce in January 1975, that the US government raised the interest rate in the US, and the gold price fell from $200 an ounce to $100 an ounce, a 50% decline in 9 months. There were many investors who, as a consequence of the gold move from $35 an ounce to $200 an ounce, that were suddenly gold faithfuls, really believed in gold. It took only 9 months and a 50% decline in the gold price to have those gold faithfuls wish that they didn't know how to spell gold. And those who were shaken out by the decline missed a move from a low of $100 an ounce to a high of $850 an ounce in 5 short years. The point of this, I hope, is that we are really truly in a secular bull market, but that bull market will show you cyclical declines, and those cyclical declines will test your patience. If you understand why you're invested in gold, if you understand something about the value of the gold stocks you own, you won't be shaken out by price. But if your information leads you to be the same type of investor who got shaken out in 1975, you will receive, and in fact you will deserve the same fate that they did. I note too from this audience, well, I note from addressing audiences like this, that if I asked any of you individually to describe your investment traits, you would describe yourself to me as sober, conservative investors. I know by virtue of the fact that you're here at this forum that you're actually wild speculators, which is good. But we all must be self-honest to survive the circumstance and thrive in the circumstance that's coming to us. And as a consequence of that, rather than talk, as I often do, about the gold juniors or about the gold seniors, pardon me, or about gold itself, I'm going to talk about the juniors today. Looking through the exhibitors, I didn't see Franco-Nevada, I didn't see Agnico Eagle, I didn't see Exxon. So there's no particular point, I think, with me talking about investing in the majors, because the majors aren't here. So in talking about the juniors, I'm going to torture you a bit. I'm going to make you sick, truly sick. But then afterwards, I hope I'm going to make you well. If I only make you sick, Kai will never invite me back. Ever. But yes, but I have to introduce some tension into my speech. If you look at the junior exploration sector as a whole, let's say that you merged every public junior in the world, there's about 3,000 of them, into one company, Junior Explorco. It would be an interesting company. That company would lose, on average, $2 billion US a year. In what they would call a good year, when they could raise a lot of money, they'd lose $10 billion. So one wonders, maybe somebody in the crowd can answer this question for me. What would you pay for this company? What would you pay for the privilege of losing $2 billion a year? Would you pay 8 times losses? Do I hear 10 times losses? In a bull market, 15 times losses? The point of this is that if you look at the length and breadth of the junior market worldwide, the sector is valueless. It's worth nothing. Haven't made you guys sick enough yet? Especially the exhibitors? Now I'm going to make you well. What that fact disguises is that a small number of the issuers, perhaps 10%, generate so much performance over the cycle that they add legitimacy and even luster to a sector that loses $2 billion a year. Your future in a gold bull market as a speculator is all about stock selection. For 50 years, people have asked me, Rick, if the gold price goes up, what do you think will possibly happen to the shares of Consolidated Orangutan or Amalgamated Aardvark? And I'm forced to say to these speculators, sadly, Amalgamated Aardvark doesn't have any gold. They're looking for gold. And if the price of something that you have doesn't goes up, but you don't have any, what impact would that have on value? If you're investing in the sector, you're making a mistake. You have to invest in individual companies, and we'll talk about investing in those individual companies in a while. But I want to begin to equip you in this gold bull market in a way that you don't waste it, because it really, truly is all about stock selection. Now, you've done the first part of the job. You've come here to the conference. Many of you have interviewed 20, 25, 30 companies. That means that you're out competing many of your fellow speculators. But keep at it. Don't invest in the sector. Invest in individual companies. I've had the really good fortune, and many of you people know this and have in fact taken advantage of it. For 35 years, I have, for free, analyzed investors' natural resource portfolios. Naked commercial. Any of you who want to do this, go to ruleinvestmentmedia.com, list your natural resource stocks, and I will rank them 1 to 10, 1 being best, 10 being worst. And I've reviewed literally tens of thousands of portfolios over 35 years. I hope I've taught a lot, because I've learned an awful lot. Ranking thousands of portfolios, you learn what speculators do right, what speculators do wrong, and portfolios that really interest me, what I do is I either call or email the person who submitted the portfolio, and I try to debrief them if I think they've either been spectacularly smart or in certain cases spectacularly stupid, and learn what I can from those data sources. And I want to share with you 4 very, very, very common mistakes. The most common mistakes that I see. First of all, most speculators own way too many stocks. Way too many stocks. More stocks than they can possibly follow. More stocks than I can follow. And I have a staff and I do it full time. I'm going to urge the people in this room to own the number of speculative stocks that corresponds with the number of hours per month you intend to spend researching your portfolio. If you're willing to spend 10 hours, I respectfully suggest that you own 10 stocks. And when I say research, that doesn't mean listen to Rick Rule videos, although I think you should do that too. It means that you should read annual reports, quarterly reports, resource statements, proxy statements, management information circulars. Actually do the work. When I interview people who send me portfolios that have 100 names, very commonly we'll go through the names and let's say the first name on the list is Amalgamated Aardvark. I'd say that for AA. And the person who submitted the list will often say, Rick, what do you think of Amalgamated Aardvark? And I have to respond honestly, until this moment, I wasn't aware of its existence. I don't think anything of it at all. What do you think? And the gentleman or the lady will respond, well, I don't know enough about it to comment. Why do you own it? Yeah. Well, I own it because Bob Bishop recommended it. Well, Bob Bishop retired 16 years ago. Why do you still own it? Well, because if I sell it, you see, I paid $4 for it. If I sold it 40 cents, I'll lose $3.60. See, no, you've already lost $3.60. The question is, what are you going to do with the last 40 cents? If you're not going to sell it, you should buy more. Everybody with me? These are not tough tests, but we tend not to impose those tests on ourselves. If you're not going to waste this bull market, it's very important that you know what you own. We're going to talk more about that later. The second mistake is patience. The most consistent winner in finance is compounding. And things don't compound in a short term. Warren Buffett, not a bad investor, said he made more money sitting than he did thinking. Many, many, many speculators that I've talked to in resources have had the right strategy, but horrible tactics. They invest in copper because they think over 5 years copper is going to be in a bull market, but then they have trauma holding stock over a long weekend. If 5 years is required for the thesis to work, don't believe that you can reap the rewards in 2 months or 3 months. A young intern who, intern is financial services speak for slave. A young intern who worked for me some years ago analyzed the 10-baggers in my portfolio, at least those I could remember, going back many, many, many years. And he told me an interesting thing about patience. He looked at my own portfolio performance. And he said that the average 1,000% gain in my career required 5 years. Most of the performance in my career that matters has happened as a consequence either of large investment positions that I held for a very long time, or 10 to 1, 20 to 1, 30 to 1 speculations that still required 5 years. It's very rare that someone can generate the rewards in speculative stocks that's necessary to amortize the risk if one doesn't hold those stocks for very long periods of time. People believe that their time preference matters. People believe that the fact that they want results to happen in 3 months or 6 months matters. But the market or God or whoever's responsible for this doesn't care about your time preference, nor does the stock. It's important that your time preference is measured by the task at hand rather than what is convenient for you as a speculator. The next thing is tenacity. The second thing we learned analyzing my portfolio was that virtually every 10-bagger in my portfolio experienced a 50% decline in the share price at some point in time during the time I owned the stock. In other words, I had to have enough confidence in the value of the stock that a 50% decline in the share price didn't shake me out of the stock. This happened time and time and time again. Some of you are familiar with my Paladin story. I first got long the stock at a dime. I was rewarded for my genius by seeing the stock go from a dime to a penny, a 90% decline. If you've experienced a 90% decline, you don't have a hold. You have a buy or you have a sell. When I reviewed the value proposition of Paladin, I decided that I was right and the market was wrong. Mercifully, I didn't sell. And I watched the stock go from a penny to $10 in 7 years. A less dramatic example would be Silver Standard. I remember doing that stock, doing a financing at 72 cents with a full warrant, watching the stock go to 250, thought I was really smart. Saw it go from 250 to $1, thought I was not so smart. Saw it go from $1 to 450, saw it go from 450 to $2, saw it go to 7, saw it go to 5. The point of this is that had I not had a sense of what Silver Standard was worth, the price fluctuations could have kicked me out of that stock 5 or 6 times in the 7 years I owned it. And in the 7 years I owned it, it went from 72 cents to $45. Tenacity. It isn't enough to be patient, you have to be tenacious. And finally, you have to understand the value proposition around junior exploration stocks. You often think of them as asset plays. They're not. Junior resource stocks really are, in effect, technology plays. They're really about the people. They're about answering unanswered questions. You have a deposit, or you have what you hope will be a deposit. The first unanswered question might be the size. The second unanswered question might be, does it extend to depth? The third unanswered question might be the target size, the consistency of the deposition, the metallurgy. The point is that making money in junior resource stocks involves identifying the unanswered questions, trying to figure out what their value is and what the probability is that they occur. Most people that speculate in junior mining stocks have a very different technique. My friend Doug Casey describes it as got a hunch, bet a bunch. The people who follow got a hunch, bet a bunch are going to waste this bull market, which is a sin. You've been through many years, or some of you at least, many years of bear markets. We're in a bull market. Don't waste it. So I've told you a few things not to do. Now I'm going to try to tell you 9 things that you should do. And if you do these, honestly, you won't waste this bull market. The first is focus on the people. If you believe, as I believe, that this is actually an intellectual capital business rather than a physical capital business, the thing that beneficiates these assets are people. I said to understand the unanswered question. Is the person asking the unanswered question intelligent? Are they equipped to answer the question? How many people in the room are familiar with Pareto's law? Half, okay, pretty good. Pareto's law is the social science dictum around the 80-20 principle, the fact that 20% of the people accomplish 80% of the work. What's interesting about it is if you put that 20% through the same performance dispersal curve, what you learn is that 20% of the 20 do 80% of the 80, and so on. What you learn in a subject as big as mining is that about 1% of the population base generates 40% of the utility in junior mining. You'll recall at the beginning of this discussion, I said that the industry as a whole is valueless, that only about 10% of the issues are worth owning. The best way to determine whether an issue is worth owning is whether the people involved in that issue are serially successful. And whether they're serially successful at the task at hand. When I look back over my career, 50 years in this sector, the vast majority of the money I've made from people who already made me money in my 30s. The Lundins, Robert Friedland, Bob Quartermain, Ross Beatty, a handful of people who made me money and then made me money and then made me money and then made me money. The truth is that you have to identify these serially successful people, but you have to do more than that. You have to determine that their success occurred in a task that resembled the task at hand. If someone's success was operating a gold mine in 2-billion-year-old rock in French-speaking Quebec, but the task at hand is exploring rather than operating for copper gold in 15-million-year-old accreted terrain in Spanish-speaking Peru, well, they're both successes in mining. The success doesn't necessarily predict the success in a very different task. And it's incumbent on you to understand that you need to associate with people who are not merely successful, but successful to task at hand. Everyone got that? I'm going to go fairly fast now. I can see from the clock I'm running out of time. And Kai will hook me. 2 or 3 minutes. You heard that. I have a witness. The second is value. Junior mining speculators are positive people. That's why they're so much fun. But you have to be rational in terms of your positiveness. When a promoter comes to you and says, you know, this property, if the mule hadn't died, the prospector would be a billionaire, and we're going to do this and we're going to do that, and you know, it's going to have $1 billion market cap in 5 years. That's all good. But it's important to figure out what it's worth now. Say, I understand the upside and I really appreciate that, but I need to know something about the downside. You've told me that your stock is selling for peanuts. In fact, you only have a $5 million Canadian market cap. Tell me what in the company is worth $5 million. This property you have, you don't actually own it, you've optioned it, right? So what you really have is the ability to earn into a project that may or may not make any money. You have to spend $5 million to do it, and you spent an option payment of $150,000. What could you sell that for to a willing buyer in the market? It's important that at the beginning of the discussion, you find out what the company is worth, not what it might be worth if everything goes right. And I'm not suggesting to you that you need to buy dollar bills for 50 cents. I'm not suggesting that at all. I'm just suggesting that you have to know something about the downside to go with the upside. What risk are you taking? It's interesting that many of us, when we talk about our investments, we can name the price today. Some of you can name the price by hour. But when I ask you what the value of the investment is, or even what the market cap of the company is, people know the share price, but they don't know how many shares are outstanding. In other words, they know the numerator, but the denominator is a mystery to them. I would suggest to you, ladies and gentlemen, that if you don't have opinion as to value, the price information is meaningless. Money's made on the delta between price and value. And if you haven't done some of the hard work to ascertain the value, the price information, while it's easy to obtain, is of no purpose. The third is scale. Scale becomes very important in this business. In the mining business, there's lots and lots of risks. The risks are big. The risks in a small deposit are big. The risks in a big deposit are big. But the money that you can make from a small deposit is small. And the money that you can make from a big deposit is big. Small deposits are big risk, small reward. Bad. Okay? Bad. If you're going to take the risk that you're taking, the risk must be meaningful. It doesn't mean you're going to work. Most of them aren't going to work. But the ones where you win have to amortize the ones where you lost. And the only way the ones where you win amortize the ones where you lost is if you make a lot of money. And it takes scale to make money. The fourth, we talked about unanswered questions. This might be the most important part of this lecture. When you go visit an exhibitor out there, you say, listen, okay, I got what you're trying to do. I got what your gross thesis is. Tell me the most important unanswered question now. Tell me what you can do that can add to the market's understanding of the value that you're creating with this project. Explain to me how you propose to test this thesis. Explain to me why the thesis isn't merely correct to make the stock price go up, but rather has been validated by ground truths. Help me understand the probability of success, and tell me how much time and money it's going to take. It might be, as an example, that somebody has a nice surface anomaly. They've trenched the deposit so that they know that it isn't transported gold. The mineralization goes to depth. Now they propose to drill, 10 drill holes, 12 drill holes. They're going to subject the property to what we call the truth machine. And let's say, just for fun, that this property is in northern Canada, where winter's an issue. And so, as a consequence, this 10 drill holes would take 2 seasons to complete, 18 months. The person that you're interviewing, the person from the company, says, these 10 drill holes will answer unanswered questions as to depth and continuity of the deposit. We believe that the project, this campaign will cost $3 million. It'll take 18 months to complete. We have corporate G&A of $1 million a year, so there's $1.5 million. So what, we're into this thing for $5 million. If the company has $2 million in the treasury and it requires $5 million to answer the unanswered question, you have to be very concerned as a speculator that they'll run out of money before the event that would cause you to make money occurs. Are you with me? When, no, I don't have enough time for this. Sorry, I gotta get going. Time, how long is it gonna take? If it's gonna take a year and a half, you have to be prepared to own the stock for a year and a half. It's important that you correlate the time required to answer the unanswered question with the amount of time that you plan to own the stock. If you don't, it isn't the market's fault, it isn't the promoter's fault, it isn't gold's fault, it isn't my fault, it's your fault. If you haven't correlated the time that you allocate to the stock relative to the task at hand, you're gonna lose. And you have to have a plan. You have to have a plan. Every stock I buy personally, I write out one page about why I bought it, what I think could go right, what the probability is, how much time it will take, if they don't have the money, where they're gonna get the money, and what could go wrong. And for me, if the reason to own a stock goes away, irrespective of price, I sell the stock. Too many people, the stock falls from $1 to 70 cents, they say, well, I'm gonna wait till I break even. Well, why would you break even? If the reason to own a stock goes away, the stock has to go away. You have to sell it. Your plan is important. I care less about what the plan is and more about the fact that you understand it and you implement it. The last admonition is this. Stocks are one of the few goods in the world that people like more as they go up in price. If one of you went out to buy a winter coat and you saw a coat at a store that last week was 400 euros and this week was 1,000 euros, you'd be furious. You'd accuse the store owner of price gouging. But if you owned a stock at 40 cents and the stock was now $1, you'd be tempted to buy more because the stock was performing. Perversely, if you liked the company and the price went down, you'd be angry and want to sell it when you should be buying. Think about financial goods as physical goods. The most important part of a gold bull market is remember that the narrative that you believe in now, the narrative that punished you for many years because you were wrong or early, as the gold bull market gathers strength, the price affirmation will make you feel better about your narrative. And you'll be becoming more confident as the market gets higher priced and is hence more risky. The most important part of not missing a bull market is to remember that when all your neighbors who aren't here now are here, sell. You haven't made the money until you've taken the money. I've said for many years about commodities, and I'll say it about gold, you have two choices in life. You can be a contrarian or you can be a victim. The choice is yours. We've been given this wonderful bull market. I hope y'all don't waste it. Thank you.
Well, thank you so much. Rick, it was a great privilege hosting you here at the Deutsche Goldmesse. I think there's invaluable wisdom that you shared with us. Just a little token of our appreciation. Tremendously appreciate it. Should we do 2 questions?
Happy to.
Happy to. I know you've been surrounded by people all day, so I'm not sure if any questions are actually left.
Actually, one more thing. For any of you who haven't submitted your portfolios, I'm a very harsh grader, so submit them at ruleinvestmentmedia.com. Don't be discouraged. I'm a harsh grader. As you could probably tell from my talk, I'm not very sentimental about my stocks. The second thing is that we have 265 hours of free programming, educational programming, at the Rule Classroom. Free is a very good price. That comes with a full money-back guarantee, by the way. So join me at the Rule Classroom for 265 hours of free instructional programming.
Fantastic, awesome. Rick, thank you so much. Any questions for Rick? We got maybe time for 2 questions. Gunther.
I just wonder when you said that if you combine all those juniors together, they make like loss of 2 billion or 10 billion a year. So did you also include like gains from selling our junior companies?
Sadly, yes. The gentleman, I'll repeat the question. The gentleman asked, when I castigated the industry for losing so much money, did I include the gains that were made from people selling their companies to other companies? The answer to that is sadly, yes. It isn't merely operating loss, it includes capital loss.
Thank you.
Raymond, last question.
I wonder, in your lifetime, what was the biggest investment mistake you made?
Biggest investment mistake I made? That one's easy. I'm embarrassed. In the decade of the 1970s, I was a young man, and I was early in the resource game, and I made a lot of money. I mean, from a young man's standard, I made an insane amount of money. Being a young, testosterone-driven male, I confused a bull market with brains. The oil price went from $2 to $30, the gold price went from $35 to $800, and I thought I was smart. I also didn't understand that the cure for high prices was high prices. All the big thinkers in the world, you know, the Club of Rome, people like that, said the oil price was going to go to 200. They said that 20 million people a year were going to starve to death. They thought that the resource price was going to go up forever. And I forgot that markets work. When the resource market of the 1970s collapsed, all I had left was my debt. And I went from being a very wealthy young man to having a net worth below zero. But mercifully, I also went from being a very hubris-ridden young man to a substantially more humble and well-educated young man. So my mistake was not understanding that markets work, not understanding the contrarian dictum. In that, I was like your parliament, like our Senate. But the truth is that the cure for high prices is always high prices. And the cure for low prices is always low prices. And the tonic is time. That was my mistake.